Welcome students. This is our options demo class. In this we are going to cover the basic important aspects about options trading, how options can be helpful for our intraday and for our positional trading, what important trading strategies we should apply for intraday and positional, and what important things we should learn, and how we can easily manage our risk, and what are the things we should learn before entering into the options trade. So what is put, these few important things which a option trader needs to learn before entering into the market, or how to identify the trend of the market, and what is the important concept about derivatives market. So all these basic important element things we are going to cover in this options demo class. So let's start this options demo class. Now this option is a part of a derivative. Now what is a derivative? Derivative is a word, or we can say derivative is a term or whose product whose value is derived from the value of one or more basic variables. So in a simple word or in a simple language, if we want to understand the options is a part of a derivative market. Okay, now options we can say is an tool or is an instrument, is a part of the derivatives market. Like derivative is something whose value is derived from the value of one or more basic variables. For example, if we want to understand the concept of derivative, so we can say that if product of a butter, if butter is a part of a derivative whose value is derived from the value of milk. So if in future the price of milk is going to appreciate, or if the price of milk is going to decline, then the same effect will can be shown, or the same effect will happen on the in the same proportion in the costing or in the pricing of the butter, because butter is directly related to the production of the milk. So this is how we can understand the concept of derivative, like how we can understand the important concept and what is an underlying asset. So this is, we can say, derivative or is an instrument whose value is derived from the value of one or more basic variables. So derivatives can be applied in these segments like equity, forex, commodity. So like in these markets we generally use the term derivative. These are important regulation act, since this is just a basic elemental thing. Even if we skip these part, it's not going to affect our trading, because this is just for our learning purpose, like how derivatives got introduced into the market, what are the what is a derivative act. So these are the things which we generally learn in our college or in our schools or in our institutions. So this is something which a trader is if he gets to know about the derivatives, about regulation act, it is fine. Even if you are not supposed, even for the trading purpose, these things are not supposed to bother very much for our trading. Now if we understand the derivatives in India, like future contracts at NSE is based on Standard and Poor's CNX Nifty index, bank index, etc. Now in Indian market derivatives, we can say, I'm sure many of you would already be aware that in Indian market, in equity market, there are 3 months of expiration cycle in derivatives. Like we say them as a 3 months contracts are available for trading. Now first month contract is called the near month, second month contract is called the next month, and the third month contract is called the far month. Now what is the term here the contract means? Contract means it's an agreement between a buyer and a seller. Okay, in derivatives we can say we use the word called expiry. Now suppose this is a month of January, and expiry means every derivative contract is being traded in the terms of to be agreed over a contract to get settled over a certain period of time. So suppose if a two traders, trader A and trader B, enters into a mutual contract of buying one lot of Tata Steel share on 10th of January, and they agreed that they will close their contract on 31st of January. Okay, so this is what we call as an expiry. Means a validity of a contract. From that point of time, trading ceases to exist beyond that particular period of time. So suppose in Indian equity market, expiry is something we call them as a maturity of a contract. Means after that period, that contract is not going to be traded in the exchange. So this is what we call as an expiry. And expiry is on every last working Thursday of on every month is our expiry cycle. So on every last working day of a Thursday is our going to be expiry day. If the last working Thursday is going to be a holiday, then a day before the Thursday, that is Wednesday, would be our expiry day for that particular contract. So say suppose if a trader enters into a 1 month contract, suppose this is the month of January, and if he enters into a January contract, then the expiry of that January contract will be on the last working Thursday of the month of January. Now if he enters in the month of January into a 2 months contract, means his contract will expire in the month of Feb, that is on the last working Thursday of the Feb. And in the month of January, if a trader enters into a 3 months contract, then his contract will expire in the month of March on the last working Thursday of the March. So this is what we call as an expiry. See, these 3 months we call them as a, if a trader is trading into a January month contract in the month of January, then we call them as a near month contract. And if a trader enters into a 2 month contract in the month of January, then we call them as a next month contract. And if a trader in the month of January enters into a 3 months contract, we call them as a far month contract. So this is what we call here as a expiry. So expiry is simple thing. It's an agreement between a buyer and seller for a particular period of time, and on that particular period, on that particular date, that contract ceases to exist in the market for further trading. So on the expiry day, a buyer who has made a commitment to buy a particular share has to buy anyhow, and the seller who has made the commitment to sell that share has to sell his share at whatever price on that last working day. So on the last working day of the contract expiry. So this is what we call as a expiry of a contract. It's a legal agreement between buyer and seller. Now in derivatives, there are actually two terms we use as a future and options. Now what is a future contract? Now future contracts are the organized standardized contracts in terms of quantity, quality, delivery time and place for settlement of any date in future, and they are only traded in the exchange, or we can say they are only traded on exchanges. Like, what is a future contract? In simple words, it's a standardized contract between a buyer and a seller. Like, if you want to buy something or a trader wants to sell something, it's a mutual agreement on a with a legal document with certain terms and conditions, like quantity of the contract, the quality of the deliverable item, the delivery time and the settlement mechanism. So a future contract is something which ceases to exist, which is actually exist in the market to be traded on a future date. Say suppose Mr. A agrees that he will buy Tata Steel share on 30th of January. Say suppose today is 10th of January, and he made a contract with Mr. Trader B, that Trader A agrees that he will buy 100 shares of Tata Steel from B on 30th of January, and Trader B also agrees that he will sell his 100 shares of Tata Steel on 30th of January. So today is 10th of January. They agreed to trade a contract. They agreed that they entered into the market to trade on a particular day, that is on 30th of January. So they both agreed on a same day of same quantity. Like Mr. B is going to sell 100 shares of Tata Steel to A on 30th of January, and Mr. A is going to buy 100 shares of Tata Steel on 30th of January. So this is a standardized contract, or this is an agreement between a buyer and a seller. So we can say that futures generally we use them as an hedging instrument and are used to reduce the risk of a price fluctuations in the underlying asset. And the problem which generally we feel conventional traders used to feel in the forward market, that is a liquidity problem, is generally does not exist in the future market. So these are the benefits of trading in the future, but we are not going to cover this future part much more here, because this is about the options. Further, the credit risk of the transactions is eliminated by the exchange through clearinghouse. So every exchange has a clearing mechanism settlement. So once there was some credit risk problem, that is a responsibility of the clearinghouse, and they will manage how to clear the problems of these kind of things. And the problem in falling market as well as the rising market, generally a profit happens in the future contract. There is a flexibility of the trade, like even you can earn the profit in the falling market, or even you will earn the profit in the rising market. So that is one of the key aspect of introducing this derivative system into the trading market, into a stock market for future or options. Now before we move further, we will say the basics of the options. Say, what is option? It's an expiration. These are the four important basic things about options: expiration of the date, volatility, what is American option, what is European option. Like, what is an expiration day? We have already discussed about that. Final date options that can be exercised means the day where a trader can exercise his or rights. Volatility is a risk factor, or we can say volatility is something, a panic factor, which drives the pricing of the option, or which determines the premium of the option value. Now what is option in a simple words? If you understand, like, option is a small token of amount given in exchange to fix something to trade on a future date. Like, in terms of property, we can say, suppose if you want to buy a property, okay, suppose the property is valuing around rupees 10 lakh, and what we did is we gave a premium of, say, suppose 10,000 rupees to a broker, and we said that on that particular date we are going to buy our property. So what happens on that particular date? Say suppose on the already agreed date, we agreed that we are going to buy that property of 10 lakh rupees, but instead of paying that 10 lakh instantly, we borrowed some time, say suppose 1 month, and we said that remaining amount will be given to them on that particular date. So suppose on that particular date, what happens if the rate of the property shoots up from 10 lakh to 15 lakh? So what a trader or what a buyer will do in this case, he will he will give the difference amount, that is for 9,90,000 to the trade broker, and he will get his property, because the agreement was for the, on the paper it was for the 10 lakh. So this is the premium paid in advance to trade his property, or to fix something to be executed on the particular date. Now suppose what happens if a trader instead of rising, instead of the price, if it goes from 10 lakh to say suppose 8 lakh or 7 lakh, instead of rising, the price of the property fell down to 7 lakh or 8 lakh. Now what will a trader do? He will eventually will not go to the trader, he will not go to the broker, and he will just clearly back off from the deal, because property price has already been reduced from 10 lakh to 8 lakh. So instead of bearing the cost of 2 lakh, he will just think, and he will just forget his 10,000 which he has given to the broker. So that is the maximum loss a trader can get into a options trading. So this is what we call as an option. Option is a premium paid in advance to book something to execute his or her contract for that on that particular date. So this is what we call as an option. Now in option there are two trading concepts. One is called American option, that is American option, and other is called the European option. Now American options can be exercised before expiry, but European options can be exercised only at the expiry. Now suppose we again go back to the example of the property. So suppose if a trader or if the buyer goes into for the American option. So suppose if he trades into the American option, okay. Now if he trades into the American option means suppose he, that is on the 10th of January, he went into the contract with a broker, and they agreed that they will exercise their contract on the 30th of January. Now but there is a flexibility in the American contract. Now what is the flexibility? That he can buy that property anytime before 30th of January. So even if it is on the 15th of January, even if it is the 18th of January or the 20th of January, he will, if he sees that price of the property from 10 lakh, it went up to 15 lakh, he will eventually go to the broker and he will pay the difference amount of from 10 lakh, which is the agreed price at the point of entering into the contract. So he will pay the difference amount of 9,90,000 and he will obtain his property from the broker. So that is the flexibility of the American contract. But if he is trading into the European contract, so even if the price of property went from 10 lakh to 15 lakh, he will not be able to exercise his rights. What he will do is he would be only able to exercise his rights on the day of the expiry, that is the 30th of January. So whatever the price it was on 30th of January, he will have to bear the difference. If the price is trading at the level of 12 lakh, even then he will get his property at the rate of 10 lakh. So that is, his rights can only be exercised on the day of the expiry. So this is the one example of European option. So in Indian market, in index or in stocks, both only European options are being traded in the market. But prior 2010, American options were used to trade in the stock market, in stock equity market, and for index we use European option. But now in equity or in index, both European options are being traded in the Indian market. So this was about basics on options. Let's move forward. Now there is a difference between future and options. Now what is the difference between future and option? Now we say future is an agreement to buy or sell a specified quantity of the underlying asset at a price agreed by the buyer and the seller. Okay, means future is an agreement between the buyer and the seller, and because both the buyer and seller have the obligation to buy or sell their quantity. But in option, the buyer enjoys the right but not the obligation. If the buyer wants to buy the property, he will buy. If he is not interested in buying the property, he will just simply back off. So only the buyer has the right to buy. But in future, buyer and seller both have the obligation to buy and sell their contract. In future, there is a unlimited profit and loss. There is an unlimited chances of loss and also the unlimited chances of profit. But in option, there is a very limited chance of loss, because the only loss he can bear is the amount of premium he has paid to obtain the contract, to obtain his position in the contract. So that is the main difference between the future and options. And in future contracts, the prices are affected mainly by the prices of the underlying assets. Now what is the underlying assets? From the value whose value has been derived. Like suppose if the price of the butter will eventually increase when price is affected by the increase or decrease in the rate of the milk. So the value of the butter will depend upon the value of milk. But in option, there are plenty of other factors been involved, like price of the underlying asset, like time remaining of the expiry of the contract, volatility in the underlying asset. So these things are being considered for the options pricing. Now there are basically two type of options. One is call option, and one is put option. Now what is a call option, what is a put option? Now put option or call option, here if we just go by the definition, like call option, buyers have the right to buy the underlying asset at a particular strike price. This is what we call as a call option. And the put option, buyers of the option have the right to sell the underlying asset at the strike price. Okay, in call option buyers have the right, and in put option sellers have the right. Now who are the option sellers? Now, the option seller has the obligation to sell the underlying asset, because option sellers does not enjoy the right. Only the option buyers have the right to buy or sell the underlying asset, but option sellers have the obligation. And the put option also has the obligation to buy the underlying asset from the option holder of that strike price. So this is the main difference between the call option and the put option. Now there is an important piece of information which we should understand and we should learn about the options trading. That is what we call as a volume and open interest. It's very important thing to learn about the volume and the open interest. Now what is the volume? If we say volume is the number of the contracts of a particular option contract that have traded on a single given day, like suppose on X date, suppose on 10th of January, the total buyers is total buyer and the total seller who traded into Tata Steel, say suppose 10,000 shares, say suppose 500 shares have been bought and 500 shares have been sold, so total volume is 1000 shares. So this is what we call as the number of contract of any particular option contract traded on a given day. So this is called the volume, and volume exists in both cash market and the future market or in the derivative market, but the open interest only exists in the future market. Open interest does not exist in the cash market. Okay, so open interest, if we understand, open interest is the number of option contract for a particular stock at a specific strike price and a specific expiration date that were open to close of a trading on a proper prior trading day. Means open interest is the total number of option contract which is still pending in the market and which is still yet to be executed. Like in open interest is, suppose Mr. X and buys a one lot of Tata Steel. Now until he closes his position, until he completes his buy and sell cycle, his open interest will remain 1 in the market. His open interest will stand 1. Even if another trader B enters into the market by short selling one lot of Tata Motors, his open interest will stand 1 until he closes his position in future. So that is what we call as an open interest. Means the total number of outstanding contract which is still or which is yet to be executed into the market. So that is we call as an open interest. Now in a simple way, simple term, we will understand what is open interest. I'm sure it is a bit complicated here. Say just understand it with an example here about open interest. Suppose generally people have a misconception that open interest is same as the thing in volume, but it is actually not. Now say suppose on January 1st trader A buys one option and trader B sells one option contract. So the total open interest in the market is how much? That is 1. Now on January 2, trader C enters into the market, another new trader. He buys 5 option contract and trader D sells 5 option contract. So there are 4 traders into the market, that is A, B, C and D. Okay, so total open interest in the market is 6, because C created 5 open interest into the market and D created 5 open interest into the market, because and both every contract has a buyer and seller each, because a contract cannot exist merely on the terms of buying or mainly on the terms of selling. So every contract has the same number of buyer and same number of seller. So the total open interest here is 5, increased by 5. So total open interest is now 6. Now what happens on January 3rd? Trader A, who was into earlier in the buying position, he closes his position, he short sell his position and he books the profit or loss. He sold his contract to the uh, trader D, one contract. So one contract get removed, one A closes his position and D was earlier in the selling position. He bought one contract from trader A. So trader A and D agrees into the market and their one contract get eliminated and their one contract get reduced from the market. So now 6 minus 1 is the new open interest into the market, that is 5, means open interest has reduced because A closes his position and D closes his position, and A and D both agreed together to close their position. So this is what we call as a reduce in the open interest. Now fourth thing, trader E buys 5 options from trader C, who sells 5 option contract. Now another new trader comes into the market. A new trader E jumps into the market and he bought 5 option contract from trader C. Now trader C on the January 2 was on the buying side. On January 4th he closes his position by selling 5 option contract which he already bought on January 5. So trader C closes his position and he gave his position to trader E, new trader. So there would be a no change in the open interest because it's only a hands of exchange. No fresh open interest been created into the market. So this is how we say that open interest remains same. Now if open interest remains same and new players are keep coming into the market, then we should understand how the market is going to behave in future. Now this is the next topic we are going to discuss here. Now this is one important concept of identifying the trend or identifying the distribution or accumulation pattern into equity market, that is effect of volume and open interest, and how we should understand the concept of volume and open interest. The detail we shall not be able to cover in here. Okay, so this is just a glimpse of how we should understand the concept of volume and open interest. Now there are 3 factors here, that is one is price, one is volume, and another one is open interest, and then it's the interpretation. Now the possibilities here which generally we see in the in terms of volume and open interest, like suppose if the price is rising in a market, okay, of any XYZ stock, if price is rising, also the volume is also rising further and the open interest is also rising, means market is in strong bull trend. If the price is rising, volume is falling and open interest is also falling, it means no new player is getting entered into the market. Only if open interest is getting reduced, means that people have started booking their profit, means the people who have created a long position in the market, they have started unwinding their positions. So this is what we call as a profit booking in bull market. Now the third condition, if prices are falling, volume is rising and open interest is rising, it means market is weak, means market is in strong bearish trend, means more and more short positions are being created into the market and more players are getting into the market with an objective of short selling. Now if we consider the fourth condition, if price is falling, volume is also falling and open interest is also falling, means market is strengthening. People who have created their short positions, they have started covering their shorts, and from there we can see that price will eventually start reversing from bearish to bullish. So we should understand these 4 combination of open interest and volume in respect to the price. This is very important, and let's see here the concept of it on the detailed chart, on detailed table. We will come to this point. Generally people get confused, like is increased open interest is bullish, No, actually the thing is, increased open interest is not bullish. Increased open interest depends upon in terms of the pricing. If price is rising, then we can see increased open interest is bullish. But if price is falling and open interest is increasing, then it is a sign of a bearishness into the market. So this is what we call as a increased generally people get confused. If open interest is rising, they think that market is going to be bullish. But open interest increase or decrease does not decide the trend of the market. It only will tell which side the market is heading. Right here we have marked a point in there, like rise or fall in the open interest may be interpreted as an indicator of the future expectations of a market. So a rising open interest number indicates that the present trend is likely to continue in the market. Say suppose we just had an example slide before, like rising open interest indicates that present trend is likely to continue. Suppose open interest just keep on rising on every alternate day or every next day, means market's present trend is going to continue. If the present trend is bullish, then the trend is going to continue further. If the trend is bearish, then price will eventually start declining. Or if the open interest number is stagnant, then it will suggest that market is in cautious mode. If the open interest became stagnant, means we can also think that market is into a range bound market, or the trader who have created their either long position or the short position, they have started distributing their position into the retailers, and retailers are entering into the market and they are absorbing the distribution from the operators. Now if open interest starts declining, then the market suggests there is a trend reversal mood, and if in rising market, continuous decline of the open interest indicates expectation of a downtrend movement. So these are very important concepts about open interest. So detailed we will cover in our module part. Now here this is a table. You can cross refer its authenticity from its NSE website. This is a Tata Steel data about open interest. Like see here, this is a date. These four open, high, low, close are not relevant, but this settlement, then this the contract, then the open interest. So eventually we are going to learn here how we should interpret the four conditions we just tried to explain it to you 2 or 3 slides back. Say how we are able to understand that market is going to reverse their position with the help of open interest. This is very important. Now see the pricing factor. See, price has continuously started falling down, that is from 259 to 253, then 245, say 245, 247, 243, 236, 236, 238, 232, 25, 27. See the trend of the price. Every next day price is continuously kept on falling and falling and falling, and until that day. And also see something interesting, like open interest is also increasing. Now what is this suggest? Prices are falling and open interest is rising. It means market is getting into a more and more bearish zone. Now one important thing which we have to notice here, say suddenly from this level to this level, there was a same open interest, means no fresh positions are being created into the market, means the people who have created their short position have started booking their profit in this zone, because no fresh trader, no fresh player is being no fresh contract is being created. Only the people, the big people who have created their short positions at suppose this level, from this level they have started booking their profit in this range. Say suppose this is the range of their profit booking. They just kept on booking and booking until this range. Now this is the sign. From there onwards, from this level, open interest had started falling. Say suppose from 2 crore 20 lakh, then it happened to 2 crore 13 lakh, then 1 crore 90 lakh, 1 crore 70 lakhs. So open interest has started falling. And see, if open interest started falling, we just go back to our previous slide, and we in the last point where open interest has started reducing and price is getting uh, we can say price has started reversing, means market is getting into a strength mode. See, this is actually what happens here. So this is how we should understand. If open interest gets in a range, understand that people have started distributing their position, and open interest has started reducing, understand people have started exiting from their positions. No, they are not distributing, they eventually have close out their positions, they are now reversing their trades. So this is how we should interpret the impact of open interest in comparison with the pricing. Now, what a general trader or what a retail trader normally does a mistake into his trading, like this, all start buying the OTM call options or the OTM put options. Because one important thing which a trader must realize, that trading in call option is very important to understand, that if you don't have a proper strategy to trade, you eventually end up in losing your trades, because 80% of the call option expire worthless, because it is just a premium paid in advance in relevance of the time. And one thing is very sure, every option value has a time value, and 80% of the options expire at the OTM. And because of the OTM does not give you any kind of time value on the expiry day. Okay, so few technical words we have used in here, since since it's a demo class, we would not be able to cover everything in detail here. We are just giving you the overview of the mistakes a general trader normally makes into his trading. Because with each passing day that passes, when underlying stock does not move, if a stock does not move in the desired direction, your option is like an ice cube sitting in the sun. Like, with every passing day, your option value will start declining its value in terms of the time money. So this is one important thing we have to learn, that we should not buy immediately something which is looking very cheap. There has to be a proper strategy for it. Like, this is one the most important mistake a generally normal trader does. The second one is like using all purpose strategy in all market conditions. Like in options, market is not going to be the same for all the time. It just keeps on changing, whether it's in range bound trending, or it's an uptrend or downtrend, bullish, bearish, how much is the bullishness, what is the volatility factor. Like, there are many important things we should consider before entering into the option trading. Now what they generally a normal trader does is, if he learns something from someone or from internet or website, like someone has learned what is bull spread, and they'll start trading only on the bull spread. Now what is bear spread? I mean, they only have a one or two strategy, and they just keep on applying the same strategy in every kind of market situation. This is actually not going to work. Further mistakes they generally do is, they don't have a definite exit plan prior to expiration. Or once entering into the trade is relatively very easy in comparison to the exiting out of the trade. Entering is not something very difficult, like anybody can buy and sell at any particular level, but how to exit, when to exit, conditions when we should exit, these are the very important things which a trader must improvise, or which a trader must learn. Like when is the important point we should get out of the trade. So these are the important things we have to consider for our trade. A normal trader or retailer does not do these kind of calculation or understanding. Like, these are the further important things we should keep in mind, like compromising your risk tolerance to make up for the past losses by doubling up. In options, never double up your positions ever. Suppose if you are suppose if you bought something of 100 rupees, and if its value falls down to 50 rupees, does not just eventually buy in a double quantity. It is simply option value. If once it starts falling, it will just keep on falling, like a we just had an example like ice in the sun. It just keeps on declining with every passing day. So even if you are trying to double up by buying in its quantity, even then you are just doubling your losses, not actually you are having making into a profitable. So doubling means we should not average in option trading. And generally people trade in the illiquid options where there's a liquidity problem. So these are the problems which a normal trader faces into his day-to-day trading. Now another important concept is about PCR. Now what is a PCR? Put call ratio is a very important aspect for our trading. Now put call ratio is not something which tells you when to buy or when to sell. It will only tell you when the market is extremely overbought or oversold, or when the market is supposedly going to reverse. Now what is a PCR? PCR is a very popular indicator to measure the prevailing level of a bullishness or the bearishness in the market. Now suppose, remember, a put contract is bought by investors who are bearish in the market, and call contracts are bought by the people who are bullish in the market. So PCR is calculated by number of traded puts divided by number of traded call options. So if the number of traded put is greater than the number of traded call options, it means market is bullish, and if the number of traded call option is less than the number of traded put options, in the market is bearish. Don't get confused, this is a reversal impact. If I'm saying number of traded by put, I'm again stressing it, buying the put means, I'm not saying it is a buying or it is a selling, I'm saying number of traded put option. If put are being traded in a higher quantity, it means there is a bullishness in the market, and if the number of call options are being traded in more in comparison to the put, then it's a bearishness in the market. So if the market, say suppose if we are seeing, that market is having a range of 1.4, or PCR ratio is in the range of 1.4 to 1.6, then we can say market is in extremely bullish, and from there we can see there some reversal in the trend. And if the PCR ratio is in between 0.60 to 0.80, it means market is going to bullish from there onwards. This is for 0.60 to 0.80 is a very extreme bearishness or the oversold zone in the on the basis of PCR ratio. So as a ratio increases, it means that the investors are putting more money into the put options rather than the call options. So there are different ways one can interpret this option to gauge the market condition. So this was about PCR, put call ratio. Now what is trend identification and trend reversal? This is another important concept. We use moving average and candlestick pattern for intraday and for positional trading, how we should able to identify the trend and the trend reversal. In trend identification, we use midterm moving average on 60-minute chart and 15-minute or 5-minute for intraday, and candlestick and dark cloud cover and piercing pattern. These 2 points or these 2 topics we are going to cover for our trend identification, trend reversal. For intraday trading, if you are able to understand these 2 concepts about moving average and the candlestick pattern, then you are not supposed to, learn anything more beyond that, because this is a very highly effective trading tool for our intraday and for the positional. Once you thoroughly understand the concept about it, then it is going to help you in a very detail for your longer career in trading into the equity market. Because moving average and if you understand the concept of moving average and the candlestick pattern, these are the 2 very important aspects for the trading. For our options trading, we have included this concept into our options class or in the CDM certification, through which we can able to easily learn how we should earn on intraday or on positional basis. This is just an overview of a piercing pattern. This is an example of piercing pattern here. This is piercing pattern, and this is a dark cloud cover. Piercing pattern is a indication of a bullishness into the market. Dark cloud cover is a indication of a bearishness in the market. This is just an example here. See, once this is an example of bearishness in the market. Again, see, this is an example of bearishness in the market. This is an example of dark cloud cover, and if we are going to see this is our piercing pattern, this is piercing pattern, this is again piercing pattern. So these are the important piercing pattern concept on which we are going to learn our intraday and positional trading. This was just to show you the effectiveness of it. See, this is the role, this is the midterm moving average here. These are the three midterm moving averages here, which tells us the trend of the market. Once the price falls below this level, it starts going down. Once the price goes above this, it shows a bullishness, then again it's a bearishness, then bullishness. See, this is how the price is actually behaving on this midterm moving average. In combination with this, we have used these two indicators. This is a very simple indicator to learn and how we should work on it. This is a very important trading concept. See, this is another example here. This is we can say is a piercing pattern, bullish trend. Again, this is a piercing pattern, it's a bullish trend. So these are the important things, this bullishness. Then there is a dark cloud cover in here. This is a dark cloud cover. This is an early indication of trend reversal. So we have to learn like at what point of time we should understand the dark cloud cover and piercing pattern for our trading. Now generally these are the important questions like a normal trader asks when they are so curious, and once they have some experience about options, like how they should trade, like what is open interest, we have already covered about it, like what is change in open interest, like what is IV implied volatility, now what is volume and what is strike price. So volume and of course the strike price, these are the important things we should learn. Now what do we need to make a decision for our trading? Say suppose, now important thing is find out the strike price and the open interest for our trading. These are the four things which we should learn for our intraday and positional trading. First is find out the strike price and the open interest where we have maximum open interest. OI represents open interest. Here you can see for the reference open interest in put and the maximum open interest in put. Find out the strike price where we have maximum open interest in put. Second, find out the strike price and the open interest where we have the maximum open interest in call, that is maximum OI in call. Third, find out the strike price and the change in open interest. Here we are referring the change in open interest where we have maximum change in open interest in put. Fourth condition, find out the strike price and change in open interest where we have maximum change in open interest in call option, that is maximum change OI call. We have to find out these four factors for our intraday and positional. For our intraday trading, what we require, we have to look these two important things: change in open interest for intraday, and for positional, maximum open interest and call and put for our positional trading. You can get the data from the NSE website too, like where is the maximum open interest in call and put and where is the maximum change in open interest in call and put. So maximum change in open interest works only for the intraday because NSE within every 5 minutes or every 2 or 3 minutes they just keep on updating their database, and even in your trading terminal you will get the maximum change in open interest in call and put. So these are very important things we should learn before to get into the market selection, whether you are trading for intraday, whether you are trading for the positional trading. As we have explained just before, like for intraday trading we would be using change in open interest concept, and for positional swing trading we would be using maximum open interest and call and put. Now suppose that is few rules we have explained in here, entire we will not be able to cover, only 3-4 rules we would be explaining it to you. First one, very simple, if maximum change in open interest in put is greater than maximum change in open interest in call, then it is a bullish market. Okay, so don't get confused about the terms we are using, call and put. Whatever we are saying, keep focus on it there. When we are saying maximum change in open interest in put is greater than maximum change in open interest in call, it is a bullish market. Second condition, if max change open interest in put is less than max change in open interest in call, then it is a bearish market. Again, we are referring here max change. It is used for intraday trading. Okay. Now for third condition, for positional or swing trading, use the open interest instead of change in open interest. For positional trading, we will use only the open interest, not the change in open interest. And the same rule 1 and 2 will follow the rule 3. Let's move on to next slide. Now, does volume in options chain data play any role in our decision making? Yes, certainly. The volume data to decide whether it is a strong bull or the strong bear, because volume helps us in telling us whether the market is in strong bull or the strong bear. So let's take an example here how we should interpret this statement. Now let us say at 6100 level we have the maximum change in open interest at call. Say suppose 6 lakh position, means suppose 6 lakh positions have been changed in 6100 call level, and at 6000 level we have the maximum change in open interest at put, that is 11 lakh position. Okay, now 11 lakh is greater than 6 lakh, very apparent, that is put is greater than call, so it is a bull trend. Okay, if put is greater than call, it is bull trend in maximum change here. See, we are referring the maximum change. Now let us look at the volumes at 6100 CE and 6000 PE. If 6100 CE has a volume of 5.5 lakh and 6000 PE has a volume of 17 lakh. Now compare the change in open interest and the volume at 6100 CE. Now volume at 6100 CE is, now 6100 call option is 5.5 lakh, which is less than 6 lakh. Okay, so it is not a strong bull trend. Had the volume been greater than change in open interest, then it has been a strong bull trend. So this is how we can understand the concept, and the same logic will apply for the strong bear trend also. So this is just an example like how we should understand and how we should read the data from NSE website, and how we should read the concept to identify that market is going to be trend in trend, or when the market is going to change its trend, or when the market is going to be range bound. So what if the volume does not indicate like above? So this was the condition, volume does not indicate anything like this, then the most probably the market is trading in a range. So this is an example, like when the market is trading in range, we should apply the trading strategy to trade in the market of a range bound market. So these are important concepts through which we can able to learn the basic reason behind how we should trade upon into the market for options trading. Understanding the option open interest data is very important. So before any strategy we should apply into market, we should understand like we should understand the trend of the market to before getting into the trade. So this was about the rules. There are plenty of other rules also associated, not plenty, I mean there are another 4 or 5 important rules also for the open interest. Then because open interest is very important concept for our trading, because open interest tells you exactly where the market traders or the market operators are making their positions, or in which side you should make the position, whether you should make the position on the bull side or the bear side, or you should just go with the time. So you should understand like how FIs are planning their data, or how FIs are planning, or how the DIs are trading into the market. So the logic is very simple. Now most of the time what happens, when DIs are selling, FIs are buying, when FIs are buying, DIs are selling. So this thing happen every time, like they always most of the time, I mean 99% of the time, they always make their position against each other, because market is been regulated. If the market becomes very volatile, it would become very difficult for the retail trader to enter into the market. So until unless FIs or DIs attract retail traders into the market, they will not eventually get the profit. So the profit will only comes from the pocket of retail trader. So a retail trader must understand the basic concept, like how they should understand the open interest concept, or they should understand in which side they should make the position. So this is what is important to trading into the market. These are another few rules here. Because of the scarcity of time, we shall not be able to cover the entire concept of this change in open interest and open interest, like volatility, historical volatility, and implied volatility. Now generally what happens, what is the important concept of a trader or mindset of a retail trader? We are just going here, the psyche of a retail trader. Like generally what happens, this is my personal observation, or it might be different from the people who have been into the market for quite some period, because this is an important observation. Like some people, or most of the people, especially the intraday traders, make quick and fast and huge money when the market goes down, because they are good at selling. And it is because when the market goes down, it goes down like a rocket, and when the market goes up, most of the time either there is a gap up or it goes like a snail pace. And the intraday traders that I am talking about do not have the patience to wait in the bull market and whatever quick money they made in the bear market. So they lose all the money and their capital in the bull market. In summary, it is to do with their mind. Their hands will be always itching to sell, sell, sell. It's a very big problem. So whenever they see market has market went some 50 point or 100 points, they just keep on selling, like they in the anticipation that market will fall from this level, market will fall from this level. This is a psyche game created by the FIs and trader. FIs are the operators of the DIs. So if you understand their open interest data, you would clearly understand like how they are actually playing with our psyche. So this is very important. So how to overcome this psychological problem? We can, next time when the market is going up, try the pair trading concept. So pair trading, you have to sell the pair. It is very important because pair trading gives you a very good chance of trading on every day. Pair trading is a kind of concept which works even in the range bound market or even in the trending market, because this helps us, or this with this help we would always be in the trend, whether the trend of the range bound, whether the trend of the bullishness or the bearishness. So pair trading is a very important concept for trading into the market. This was just a recent observation we have made into the market. Like, let's take an example. So suppose in the morning when maximum change in open interest was 6200 and 6300. This is just further example of open interest observation, like how we should interpret when the market opens at 9:15. By 10 o'clock our trend would eventually start showing the trend for the day. Like suppose change in the open interest at 6200 PE was greater than the change in the open interest at 6300 CE. So it means it's an indicating a bull, and the market made the high of 6274. It's a bull in bullish indication, and the market made a high of 6274. Now change in open interest at 6200 PE is 3.68 lakh, and for 63 it is 4.95. So 6300 CE is greater than 6200 PE. So it turned from bullish to bearish. So this was an observation. So overall change in open interest at 10.38 lakh, PE at 6.09 also indicates a short sell, and the overall open interest in the morning itself, I told it was a bearish trend. So this is how we should interpret the trend of the market. So it requires a bit of practice. If you just keep on observing these kind of data over a period of 2 weeks or 3 weeks, you will clearly understand like how we should trade for this concept, like how the open interest has been changing, how the open interest has been created or being converted by the trader or the operator, like how they are manipulating their game in the terms of open interest. So the entire game has been manipulated in this derivative section of open interest, that is call and put. So if you understand the game of the call and put, then eventually you are with the big players. So here, this is an important concept of understanding the open interest trading. Now these were the concept which we are going to cover into our course. So our course is about, this is a certified derivative master program. In this, we would focus on the basic as well as in the advanced trading strategies and learn how to control risk and generate income with options. This is a very important thing. Like, our focus would be on generating and make you learn the basic and advanced trading strategies, like, and the important churning out of the data, how you should interpret the data, because this course will take you your option trading skills to a higher level with step by step. There would be a detailed very important things which I have only gave you the glimpse of it, because entire topic cannot be covered in a 1 hour of presentation. So we just gave you the glimpse so that you get a fair idea like how we, or what are the important areas we should focus upon. So this is the course will also help you in boost your career in finance, investment banking as a business analysis, and help you become a derivative master in short term. Our course is also internationally recognized. We have providing training to the overseas partners. We have our students also from Canada, like there was a recent student also who has been given this certification, and after the certification he also got the permission to write a book, and his now book he recently wrote a book and it now has become one of the top best sellers in the market. And the course structure has these 3 levels, that is introductory level, intermediate level, and the advanced level. Now this is a detailed understanding of this is the introductory level. There is a concept of derivative trading, like very basic and elemental, future contract, basic of options, what is volatility, why we should use options, then option terminologies which we generally face. Then there is a summary and a conclusion, and then the second topic, module 2, moneyness in the option, time value. These are the important things we are going to cover. What is the difference between exercise and square off? What is the concept of option trading? What are Greek options? Greek options means what is delta, theta, gamma. What are the important things we should learn about? Like what is the delta theory? How the beta is going to affect into our trading. So everything about this option we are going to cover in this basic module. Cost of carry is also very important, whether we should take our position into the positional trading with delivery, or we should make a short sell position, or we should make a long position on the basis of cost and carry. Then there is a future strategies also. Then there is a option tool analysis. What is an open interest and volume? This point we have already discussed, like what is put call ratio, then trend identification, reversal, the importance of candlestick. Like we just gave you these 4 things which we have covered. This was just an brief overview of the concept, but detailed we haven't covered in here today. Then trading strategies on the basis arbitrage, like zero loss strategies, how we can make a zero loss trading strategies, like how we should make calendar spread bullish and bearish. Then the practical exercise would be at the end, how we should create the hedging. This is in the intermediate level. Now what is the importance of derivatives, how to use PCR, how to analyze option data, what is long strangle, straddle, short sell, the short strangle, then strap, collar, butterfly spread, then long call, butterfly, short iron call, butterfly, then there's also long iron, short iron call, butterfly, then the condor strategies, then further Nifty trading strategies, expiry week strategy, big event strategy, expiry week strategy. Then further we would also help you understand like how we should make a strategy. So very important things we should learn about the trading strategies about the course. This is just a topic. The detailed thing would be you can ask from our brochure. So this is our course lecture. Now this is the certification process here, how we would be able to get the certification. This here this is Chris Vermeulen. He was a writer we were talking about. He's from Canada. He just wrote a book about technical analysis. He's a certified, got the certification of MCTA. Our MCTA course and the CDM course is internationally recognized. Then this is the process for the certification. Here first of all you have to, at the end of every section there is a quiz. You have to submit that quiz from your online section login portal. Then with every end of the module there is an assignment you have to submit online or by through mail. Then there would be an online exam. Exam will only be you will eligible to give once you have submitted this quiz and assignments. Then the fourth step is the certification. So after the certification you can also apply, or you can also send us your resumes, through which we can circulate your resume and forward your resumes to the respective or prospective companies where you would be given call for the interviews, and you have to go through the interview, and then there would be a selection process. Then this is thing which you can eventually go for your recruitment, and if you want to build your career here. Now one important thing why a trader should go for the trading like in options, like there's very important things like we said is the cost efficiency. Options have a great leverage. An investor can obtain an options trading, like in options, even if you have a very small amount of capital, say suppose 30,000, 40,000, 50,000, even then you can get a very decent return on the investment. Like say suppose on the monthly basis you can get some 5 to 10% of investment. Few strategies which can yield you some 10 to 12% of monthly return. They're also called assured return, something called with risk of 2 to 3%, through which we can do some arbitrage. I'm saying almost assured return means there is a very negligible chance of making a loss only if you made an error on your part. So this is what we call as an almost assured return. So we have to apply those kind of strategies in here. Then further there is a higher percentage return as compared to other concept. Return on your investment would be on higher side. So all these things we have to keep in mind while trading into the options. The course features, we have two different type of courses for the CDM. Like one is distance learning program and the other one is called the online program. Now in distance learning program, what you will get, you would be getting the recorded lectures of our sessions, and you would be getting the assistance on it. And the distance learning program and the online webinar program, and the detail about, you can if you are interested, we shall give you a call and we shall explain you the difference between the online program and the online program and the distance learning program. But the mode of the thing would be, it's a convenient online classes. You would be getting the access with the time flexibility. You can also access the detail from your login portal, that is from 24/7. You don't have to generally wait for the classes. There would be a regular quizzes course having more than 200 quizzes which you have to complete, which will also help you in enhancing your knowledge. Then there's exclusive content designed by the industry expert who can give you the real trading experiences. Then there would be a dedicated support, and further there's affordable prices also, and there's also a fees refund policy also here with our course. If you opt for our course, there's also a few conditions through which you can also refund we can also refund the fees. Then the job placement we have already talked about. Like this is just an example of our investment. This is a return of one lot of investment on December month performance on our the trading strategies which we have provided. So these are the calls. You can also cross refer the calls here, and these are the things. The profit is only on the one lot. Okay, so this is what we have to understand, how we should trade into the market, and on the basis of our trading strategies. Now the benefit for the course would be, what in the course, if you want to have a practical experience, all the market experience, all the trading examples which we generally give in the market is only on the current market situation. It's not on the very say suppose 4 years or 5 years backs of example. We are not actually take those type of examples. And After the course, you would be able to evaluate how advanced option trading strategies matches your personal financial goals, even with the minimum or the very small capital investment you have. Or you will be able to learn to identify the trend bound on the range bound market, learn trading strategy for intraday and positional trading for a decent return. I'm not saying that you would be getting 1000% or 100% or 200% of return, but on monthly basis you would be able to get some 10 to 12% of a very consistent and a decent return. So I'm not giving a very very superficial number which generally allures the retail traders that they will become very rich. It's not something that you will become very rich, but you will get a very decent return. Like it's like a kind of a job. You have to spend some time, you have to earn things. Also, if you are not employed, also if you are employed somewhere, then also you can give some 30 minutes or 40 minutes or hour or so of your time in the trading market on for the positional trading also. Then even this, that would be your enhanced added income in your salary. There are other benefits also, like how to use calendar spread, how we will become create diagonals by combining these kind of time-based strategies based on vertical delta neutral strategy. Then there is also called the zero loss trading strategy. Then there is the importance of volatility and volatility based trading. So all these things we would be covering in this course in detail. And then there is the benefits for you. All obviously it will enhance or it will give a value addition in your knowledge. And benefit for your organization, we have already been providing training to the corporates and the some brokers, sub brokers with their uh, design packages. So most of that we have been also been associated with the companies like Relicare, and we have been conducted training to the companies like Relicare India. Also, we have been providing training to their brokers and the sub brokers also from time to time. So this is definitely, the course is designed with the well experienced trainers here, the traders who have been into the market for around decade or long. So you would be getting a proper support and the proper uh, guidance from our side. Further, during the duration of the course, you would be getting the online support, like you would be getting the Yahoo Messenger personalized Yahoo Messenger IDs through which you can discuss your doubts on Yahoo Messenger, or uh, these kind of facilities through ticket sizing, or through emails, through phones you can clear your doubts. So phone would not be that be supportive, because during the live market, like many, if the trainer or the trader of our organization is busy in some kind of corporate trading strategy or in some corporate tie-ups, so you would not be getting that kind of support. But certainly if through online support, through Yahoo Messenger or through emails, you will definitely get a good support from our side. Further, the course is very cost effective. Whatever, even during the duration of the course, many of you would be able to recover the investment which you have put into our this course. So the course will definitely help you in learning your trading concept and help you in improving your trading skills definitely over a longer period of time. So these are the registration details. Like we have already explained you that we are currently having two modes of learning. One is distance kit, and another is the online webinar program. The detail, if you are interested, our company people will call you up and explain you the concept about what is the difference between the online program and the distance learning program. So distance learning program will be beneficial for you because it would be convenient for you to give the time as per your convenience, and it's not also very expensive, and the trading strategies which we are going to explain you in the concept will definitely help you earn your invested amount. Then this is a distance kit learning program set where we would be sending the CD with interactive video lectures, that is with quiz and assignments. We've already explained you. Then you would be getting the live video lectures of our classroom video lectures. Then there will be tools and softwares in the ebook and trading strategies. So these are the things which you would be getting from our course. Further, payment, these are the payment options. So any mode would be can be applied if you're interested in any kind of this course, CDM distance learning or CDM online program. For registration, you can call on this number which you have in front of your screen. So this was about all our CDM course. So what you will learn from this course is like introduction to the pair trading. We have introduced this concept like how one can easily get a decent return on intraday or position on the basis of pair trading. This is what we call as a zero loss trading strategy also. Learn the option pane. Option pane will help you in identifying the expiry level, like at which level people, operators or big players are going to close the market. Like more stress on the current market activity for better understanding. Then there would be introduction of the learn volatility based trading, like what kind of volatility we should consider for our trading. Then there was the focus on market based trading strategy development. Then we have already given you about this, the concept. Online support will be given to you through Yahoo Messenger. Then there is a 1 year support for the distance learning program. Who opt for a distance learning kit, they would be getting a 1 year online support. So these are all the benefits you will able to get from our course. So this was the strategy for the week we have given here. So suppose if the market rates in the range of 6352 to 6204, it is its consolidation band. If any breakout below 6204 may drag Nifty to the level of 6012, and if market goes above or if it breaks the level of 6352, then it may accelerate up to these levels. So what we have to do here is we have to buy 6200 PE and 6300 CE each one lot, and sell 6100 PE and 6400 CE each one lot. If consolidation continues in the band of this range, then in the next week we have to book the loss. But if any breakout beyond these levels, the level of this 6204 or 6352, we will be getting at least 50-point profit in this strategy on one lot. So this is the strategy for our this week. Hope try to apply this one, the concept, and I assume that you like the concept of our trading on the basis of these options. So if any doubt, you would have our support number, or you can visit our website, or you can also write a mail to us. Every detail you would be getting from our website, and the numbers we have already shown you on this webinar video. So that was all from our side. Hope you liked it. Okay. Thank you once again for your patience time. Thank you.